Thank you, Hassan. Thanks for inviting Cross River to this really very fine event, Fintech Forum 2017. So the title of the keynote is a private equity view of Fintech. So first, I would like to introduce you to Cross River Bank, just really briefly, for those who don't know, which is probably 99.999% of this room. So Cross River Bank is really started as a community bank back in 2008. We were, I believe, one of the last, if not the last, chartered bank by the FDIC before the banking debacle and before they put a stop to the de novo process. So we really squeaked in at the last minute. Very fortunate to be able to get in. And we just started with approximately $9 million of equity. Did two subsequent raises in 2010 and 2011 of $4.5 million each. And I'll get to that in a minute with regards to the title of this lecture. So we are a tech-enabled, high-growth financial services provider. We create and provide innovative strategic solutions and returns to our clients. So basically, our mission is really to enable our clients to deliver responsible financial solutions that empower consumers anytime and everywhere. The value prop is we're a platform of innovative technologies, and built around very robust compliance, and with a seasoned leadership across the broad spectrum of the financial industry, and that includes consumer lending, credit, capital markets, compliance naturally. Over 25% of our staff is in compliance. And what we provide to our clients is three things. Number one, new finance, so alternative lending particularly, and that is a marketplace lending. So we do service and power 14 marketplace lenders in the US, some of which you may have heard, such as Best Egg, Quicken Loans, Loan Depot, Affirm, Upstart, Borrowers First, the Freedom Network, Lending Club USA, and a few others. And then we also provide payment services, bank as a service, and that includes an ACH, a PIN debit network access, gateway, payment gateway, an API for wire automation on the Fed line as well, SWIFT. And now we're in the process of combining all this and putting it on a platform. That's what we call a bank as a platform. And then the third leg of the stool is community banking. Sorry. And that means we just take deposits and deploy them into loans, whether they are commercial real estate in our footprint or small business lending activity nationally. And those three things are contributing to a fairly robust bottom line. The top line is approximately about $100 million, growing about 100% year over year. Bottom line is around 30 at the end of 2017 for a return on equity roughly of about 30%. Total equity stands at about 100 million, like I mentioned, of which approximately 60 million is retained earnings since our inception. So Cross River, a year ago, and that's when I'm getting now into the subject matter, we got unconventional validation from the VC community as we opened our capital to our first round of institutional funding. So you could call it like a Series A. So we did the seed funding, the 9 million, the 4.5, all this with friends and family, and actually they were repeat investors. And now we decided to open it up. And the way it occurred is that we actually approached most of the VCs that were potentially investing in portfolio companies that would potentially be our clients. And then one day, Andreessen Horowitz said, we have three strategic investments in three of your clients. It might make sense for us maybe to entertain an investment in Cross River. And that's how we opened our capital, and they did a round of funding of $28 million at a pretty hefty valuation for a bank. And the three, that was led by Battery Ventures, by the way, and then Andreessen and Ribbit Capital, which are fintech specialists, joined the fray for a total round of $28 million with $2 million of additional adjunct investors. So the relationship between the VC community and fintech is really complicated. And the reason why it's complicated because it's very difficult for the fintech to determine exactly what they do. And this is one of the things that I'd like to really point to. There are back-end operators and there are front-end developers and there is KYC folks, but what they mean is really just the ability to take an OCR of a driver's license. It doesn't really necessarily mean access to every single worldwide database to be able to identify the bad agents. So all these things are very important for the fintech players, the stakeholders, to determine very precisely with what is their value prop, what market are they involved in. And that's why that really led to a complicated relationship. Nonetheless, we had our most robust investment in fintech in Q2 2017, $1.7 billion in the US, $184 million of first-time investment in 107 fintech companies. That's phenomenal. That means it's really robust, the market is healthy, there is still really an acute interest in the fintech world at large. Now, some of the pros, why we would invest in fintech. Greenfield opportunity. And really, the market is very quantifiable. The regulatory environment is such that it actually forces the financial agents to disclose what is the size of their market. What is the performance of, for example, their loans? How do they access the payment rails? Through which mechanism? What are the potential fraud agents on those payment rails? How do you access your databases? So all this is quantifiable. This is something that is known. So that actually enables the fintech players to have an addressable market that they can quantify. And it's truly a greenfield opportunity. It is huge, it is massive, and it is cross-border. Number two, so again, underlying size of the, massive size of the underlying markets, the 3 or 4 markets I just described. The incumbent players, so the financial services companies, whether they're banks, insurance companies, hedge fund managers, asset management companies, 401k plan companies, whatever they may be, they really are having a difficult time to adapt. Let me just give you an example. There's a large bank in the US, probably one of the top 3. They made acquisitions over the past 20 years that they never integrated the core processors of those acquisitions. They are sitting on 200 core processors. That means that they have a branch, let's say in Nebraska, that doesn't talk to the main office, and they don't share that information on a potential AML violator with a branch in New York. They're engaged in a 10-year program to integrate those 200 core processors. And that's a $4 billion endeavor. It is lengthy, it is complicated, it is extremely pricey. So the fintech players have a role to play here to be able to enable the aggregation of all this data in a seamless manner and a cost-effective manner. Again, the opportunities for true platform players. The early entrants, particularly the neobanks or the challenger banks, they were one-trick pony show for a very long time. They were a bank on a debit card, a bank on a credit card, a bank account, sorry, but not really a bank account with the capability to have multi-currency, cross-border, with very robust KYC and core processing power, with computing power that has machine learning and AI at the same time. This is new, and this is actually very pervasive now. All the new entrants, I'm not going to mention them, but I'm sure there are some of those here, are doing a phenomenal job to address the needs of the consumers and at the same time to fill the void that the early entrants did not manage to fill. On the risk side, obviously there's a fintech risk. Are they really addressing the market properly? Like I mentioned before, is there a true value prop? The regulatory risk is huge. And the problem is not so much that there is regulation, it's just that there is regulatory uncertainty. The regulators do not know how to handle a fintech company. And there is a turf war, particularly in the US. There are 12 regulatory agencies fighting for who will regulate the fintech world. from the Federal Reserve to the OCC to the CFPB to the FTC to the SEC, all acronyms. I'm just mentioning names you probably don't even know what they mean. Honestly, I don't even know myself. So it is really a complicated meander of regulatory framework that is very difficult to decipher. And what we need to do is that to bring the regulators at the table with the fintech players through conferences such as this, and just to discuss it. How are we going to regulate this new phenomenon? Because it's here to stay. It's not going anywhere. Principal risk, obviously, fast growth versus deliberate growth. So it's one thing to grow fast, but if you grow too fast and uncontrollably, obviously that leads to disasters, particularly in the financial industry. Because the regulators, if they feel that there is a hole in that growth, they will stop that growth. And that's the kiss of death of most of the fintech players, because the investors are looking for growth. But again, it's deliberate growth, calculated growth. And then finally, the exit valuation is non-trivial. And that's really, on the next slide, is are you more fin than tech or more tech than fin? So the easy, I would say, investments for a fintech investor, such as a VC fund or a PE firm, is tools for financial services. What we call disintermediation or disruption or unbundling of financial services. The second, probably easiest, is trading risk or compliance software. Then exchanges and brokerages. And then money transfers and foreign remittance. Payment processors is probably the next really big frontier. And then insurers. And then finally, the most difficult to invest in, because it's a compliance minefield. And also there are some regulations around if you invest too much in a bank, you incur the risk of being deemed a bank holding company, which most of the VCs obviously don't want to be subjected to. Guidance. So how do you prepare yourself to sell yourself to a PE firm or a venture capital firm? You need to stoke the fire. Define a clear value prop. That means know yourself. Number two, fundamentals. Why is your business substantially superior to the incumbents? And that's really key to determine, because that demonstrates one thing, again, going back to number one, that you know yourself, you know your market, you know exactly what you're addressing. Valuation. Help identify the legacy business you're replacing and benchmark the relevant comps. Exit strategy. Know all the relevant M&A, IPO outcomes in your sector and help educate your investors about how they might reach liquidity. And liquidity is really key here because in this space, there will be consolidation at some point because there are way too many entrants. And if you want to grow and if you want to go to scale, you will need to make acquisitions. To make acquisitions in a cost-efficient manner, you need a liquidity for that. That means an exit strategy. Shed light on the risk factors because the risk factors are your friends. The disclosures are your friends. The more risk factors you have, the more, again, means that you know yourself and you know your industry. And they also protect you down the road. So, with regards to the right investor at the right time, so for Series A, I would say it's probably a VC play. For Series B, so you have a combination of VC and PE firms. Because the return expected, obviously for a Series B, the next one is very highly likely going to be an IPO or an M&A transaction. If it's an IPO, you don't want to price yourself too high in a Series A that at the IPO you're going to be like a 1.5 times or 2 times. That doesn't make really much sense for the investors. You're not going to convince investors to come to the table. So you need to identify strategic investors. That's the right round to identify them. That means, for example, a Google, a Facebook, a Starbucks, somebody who owns the consumers. One thing is for sure, is that the banks do not own the consumers anymore. They used to, on the transactional basis, no longer. You could actually have an account at Google through a Google wallet. You could have an account at Walmart. You could actually have a debit card or a credit card branded Walmart. So there's a true disintermediation of the consumer away from the financial services companies, and they actually gravitate around the consumerism, the consumer companies such as the ones we just mentioned. The crossover investors are key. That means these are the Wellingtons of the world, the Fidelities of the world, because they do have a PE element, and they also have the wherewithal to support your IPO. So that's why they're really key at the Series B level to invest in the Series B, and they don't care too much in a, let's say, a 2 times or 2.5 times return, because ultimately they'll support the stock, and that's their big play. They want to identify very early on the stocks that will perform well, not 2 years down the road, but more 5 to 10 years down the road. And then finally, the venture investors. It is key to keep venture investors at every single round, because they do bring strategic value. They bring a tremendous amount of brain trust, of board expertise, and a contacts naturally. And they also could bring a lot of clients to the table. With that, I'll leave, do we have time for Q&A? Maybe one question? No? No Q&A. Okay, it's just a keynote. Thank you very much for listening. Have a great day.